Hi, this is Dave and welcome to the weekly market recap closing out the week for Friday, January the 3rd, 2014. So we're into a new year. Happy New Year to everybody. I hope you have had a fantastic holiday and wishing you all the best for, trading and investing and, general, good health and prosperity into 2014. So let's just jump into this video here. Let's look at the Dow futures on the daily chart as is usual. And if you take a look at where we are closing out the week for the 3rd, you can see that essentially we tagged some of these initial targets around 16,400 that we've been talking about. I believe we got as high as, let me just draw a line here, I believe we got as high as around 16,000, just over 16,500. So for all intents and purposes, that the initial target range of 16,400, 16,000, just a little computer glitch there, 16,400 to 16,700, we tagged, pretty much in the middle of that target zone. So that that analysis has essentially been met, and what we expected to have happen, we were lucky enough this time for it to happen. We're not always right. Nobody is always right. If you can be more than 50% right, you're doing okay. So essentially at this point in time, I was expecting a little bit of a bigger sell-off here. We had a bit of a sell signal. We're in an uptrend here, so it's not like just go short the market, but we had indications in this area here, this pattern here, that we might get some sort of a pull down. Now you don't know, and I'm talking about the candlestick pattern there. The pattern that I was looking for was this type of pattern where you do this with the candlesticks, and I'm looking for some sort of a pullback. But the key to that is you don't know exactly where the market is going to pull back to. So in this case, we pulled into the 8-period exponential moving average. That's this yellow line here around 16,349-ish and 350-ish. And if you look at this from, a support resistance perspective, I mean, that is dynamic support. You're trailing higher, and it did find support there. I would have expected a little bit more of a pullback maybe into the 21 exponential moving average, or to retest this peak, do this kind of thing. So that's sort of what I'm hoping for. And then I want to see in this zone if we can find support and then push back to the high side. The other thing that I'm looking at is if you look at our momentum indicators, our long-term stochastic, our longer term rather stochastic, it's not that long term, but it is, our slow stochastic here is overbought. And as we've talked about, these can stay overbought for long periods of time. But what I'd really like to see is long-term stochastic is overbought, short-term stochastic is oversold. You can see it's kind of done this sort of thing. So what I'd really like to see is I'd really like to see the longer term, or the slow stochastic, reset itself. Like with this sort of situation here, this sort of situation, I'd like to see it reset itself into this sort of support zone. It's more of a zone rather than a hard level. This is kind of what I think would make me more interested in the long side of the market. I don't know if we really have, we've essentially met some of these major targets. I don't know if we're going to get a lot more upside, but I have the inklings that we may get. And you never know the future. This is just my feeling based on my analysis, some of the things I study, some of the things I read. But I think we might go much, much higher, and we may enter into another major bull market from a cycle perspective. We've got a 4-year cycle coming into play in 2014. And looking, a little bit later in the year, we may be looking at a bit of what I'm actually looking at is a bit of a sell down into the beginning of January, and then to start finding some support and then moving higher. So I'm going to be talking more about cycles going forward as I learn more about them. My knowledge with cycles is more limited than I would like, But one of the things that I am looking at is I am looking at, some seasonal factors. I'm looking at, the 4-year cycle. I'm looking at some other factors. And I mean, what my analysis is telling me is that, we could get a pull down and then we could get a move much higher into sort of a new bull cycle, or a new kind of bull market, where the market is more, I mean, the markets have been fairly one-sided here, where you don't get a lot of cyclicality. You just get a lot of, up, and then when it's ready to sell off, it sells off. More cyclical markets are more two-sided markets, where you get, up, you get down, and you can sort of play both sides of that, of those ebb and flows. We've been more, focused just on the long side of the market for that reason, because the market has been less cyclical in nature. And one of the things that I'm looking at is just having one of these kind of nice pull downs. I'd like to see it into this zone here, and then see if we can reset the stochastics, going somewhere into the middle of, let's say, the middle of January, or closer to the end of February, the beginning of February rather. This is some terrible writing. And then see if we can, find support, catch a bid, and then look to see if we can resume this uptrend and tag some of those higher targets of, let's say, 16,700-ish, and then see if we can really keep going, and then just try to see if the trend will just, persist longer than we expect. If we enter into a new bull phase, or a new sort of bull market in stocks, then, the market will go a lot higher than we're expecting. Now, I'm not saying that's going to happen, but that's kind of what I'm leaning towards. So I'm not going to necessarily, you've got to look at what the market presents to you all the time, and you have to trade the market based on what the market is giving you. So having biases in the market can, they can be the gift and the curse. So just take that with a grain of salt. As long as we're tracking above the 21 exponential moving average, I think pullback opportunities are still opportunities to buy, until and if the market tells you otherwise. So I'm approaching the market from that perspective. So just to recap, and I'm sure the other indices will look very similar, but just to recap, I'm looking for a bit of a pull down into, some support areas, and looking to see if we can resume the trend. But I really want to see momentum on my side as well. I'd like to see a reset of the longer term momentum indicators, and then I'd like to get on board when momentum looks like it's resuming its uptrend as well. So I hope that makes sense, and let's move on. I spent a little bit more time on that than I've wanted to. The S&P looks very similar. Let me just extend that right. Looks very similar, and we've got some targets up here that we've just about met around 1850, not quite, but pretty darn close. Let's look at the NASDAQ. So the NASDAQ looks kind of the same, and it seems like I'm just going to redraw this trend line here. It seems like we've established this sort of a trend line here, and this trend line is more relevant, and we're far away from that. So, we're just, we're stair-stepping higher, and we're potentially pulling into a support area. Same thing with the longer term momentum. You can see here we've got a divergence going in the MACD, and that's been persisting for quite a long period of time. And that could resolve itself at some point, maybe a deeper pullback, but we'll just have to wait and see. And if we look at, I realize I can actually get the Russell futures. I've been doing the IWM, which is an ETF that tracks the Russell and is tradable. So I don't have any drawings on the Russell here. This is delayed data. I don't have a real-time data feed, but for the purpose of these videos, it's totally fine. But let me just switch over to the IWM because I don't have any markings on this chart. The IWM did the same thing where it pulled down. Well, it did pull down to the 21 exponential moving average, and we got a nice little, almost a hammer off of that 21 exponential moving average. But, that being said, I'd like to see a deeper pullback. We may not get it. Let's just be clear. We pulled into a decent support area here. We may not get a deeper pullback from this area on any of the indices. Let me just jump back to the Dow. This might be it. This might be the pullback, and then we're going to resume higher. But I would like to personally see a deeper pullback before getting on this market. May not happen, and we'll just have to, we'll have to adjust accordingly. If we look at the transports, They look very similar. The transports are still strong. You can see the MACD is very divergent in the transports. If you look at, you know, where we are from that perspective, you know, you've got a pretty major divergence here in the transports, and you can see we're starting to roll over in the slow stochastic. So I'd like to see, you know, a reset of this cyclical kind of, you know, if you want to call it almost like an electrical sine wave. You know, some people look at the market that way, but, you know, you get cycles in these oscillators, and I'd like to see this cycle come into play and then push higher. You know, not to be confused with, you know, cyclical markets, but, you know, everything sort of cycles up and down, just like an electrical signal, or, you know, you get these kind of up-down cycles, stair-stepping. So I'd like to see this kind of cycle come into play here, if that makes sense, and reset momentum so that we can get movement back up to the high side. I'd like to trade with momentum on my side. You know, trend is important, and momentum is important. And if you watch my videos long enough, you can see that a lot of times the things that I look for is, you know, I look for, number one, I look for trend. As a directional trader, you really only make money off of the movement. And in order to catch movement, you really need to catch a trend. So there are other strategies to make money in the market off of sideways markets or non-directional markets, but I'm primarily a directional trader. So as a directional trader, trend is very important. So the other thing that is very important is momentum. So momentum, Okay, let's just clear this off. So what I was just going to say is number two, momentum is very important. You want to have momentum on your side as a directional trader. So if you're not a directional trader, that's fine. If you are a directional trader, you might want to consider, you know, getting in a position when you have a higher probability of momentum being on your side. For example, this situation here. You know, you're into a support level and momentum is shifting back up in your direction. You know, that's a little bit more, this is higher probability than just trying to get in, you know, in this area where, you know, maybe you get a pullback, it moves against you. Okay, maybe it goes higher, but, you know, at the end of the day, you're reverting to the mean right back in this area. And, you know, if you got in here and you do this and then you do that, oh, I'm in the profit, and then you're right back. You know, you're right back into your break-even point. So I think it's very important to try to catch areas of support. In my opinion, this is, you know, sort of where my trading's been leading me over the years, to try and catch areas of support where momentum is ready to shift back into your favor, and you get the lower risk entry and you catch these sort of swings. You know what I mean? You catch these swings here. You know, that kind of thing here. So this is where my trading has been leading me towards. I like this. Where it becomes very difficult to trade like this is when you don't get the kind of deeper pullbacks that you really want in order to get confident in trading the market. Like, this is not a very deep pullback, but, you know, it's tradable because you're into a decent support zone. These are deeper pullbacks, but sometimes what happens is when you get into these deep pullbacks, you start thinking about the short side of the market, and you lose track of the bigger picture. And in order to, you know, keep perspective on that, you really need to zoom out, you know, and see where's my bigger trend opportunity. You know, we're really going higher, so I don't really want to, you know, you can make money selling these if you can time them, but I'd rather be a buyer, you know, and ultimately you move a lot higher. The pressure is more, the pressure is more in your favor on the buy side in this sort of circumstance. So let's move on. I don't want to, you know, get on to just a quasi-educational rant. So let's move on to the other major markets where, you know, where things may matter or things may be, you know, moving. So if we look at the dollar index, major driver of the markets in our day and age, the dollar index is something that I like to watch. And, you know, last week we were talking about, we're putting in higher lows here in the dollar index. And if you look at here, we're just creeping, and we just closed above 80.86, and we've essentially we've essentially broken that trend line, and we're starting to put a hammer off of the top of that. So, MACD is starting to roll back over to the high side above the zero line. It's just below its zero line right now, but this is very early stage. But the question in my mind is the dollar index going to find support above 80.86 and push into the higher end of this range? It really doesn't change really anything. It's just, it's the ebb and flow back and forth, but we're still in this humongous range. So if you look at it from that perspective, it's just a return back to dollar strength. We could move into some of these higher levels and all that implies. So if we look at the euro, we were looking at $1.38-ish as the major resistance. And if you look at the euro, we basically put in a double top or a triple top, depending on how you look at these patterns, a double or triple top right in and around $1.38. As we were talking about, we didn't really think that we were going to hold above $1.38, and you can see now we're pushing back down into some lower levels. So I think $1.35 is in play, and potentially $1.34 I think are the key levels. Going back from just a basic standard support resistance analysis perspective, I think these are the two levels that are in play, and that's all I really have on that. If we take a look at some point, we may get back up above $1.38, but until and if that happens, I'm more bearish than I am bullish on the euro, even though it's in an uptrend. I think we've really put a ceiling into this market in the short term. So until and if we can get above $1.38, I'm really looking for the breakdance fight to continue, where the euro is going to go lower, lower euro. That's a terrible E, but then higher dollar. Just into some, euro into support levels, dollar index into resistance levels, and let the breakdance fight continue with no clear winner. Let's take a look at USD CAD. And USD CAD is just consolidating around this dollar, let's call it $1.06 level. I'm not sure if we're really going to get more upside from here. We're really just going into a consolidatory, I always have a problem with that word, consolidatory phase. And, we're just, we're putting in a consolidation around this level. You could consider this a bit of a pennant or a flag. Question is, we broke out of this triangle. Are we going to, do this kind of thing and then push higher? Or are we going to push lower? At this point in time, I'm still more bullish than I am bearish on the USD CAD, unless it gives us an indication that it's really going to sell off. So we're starting to look at a little bit more strength in the dollar index, and I think that might bode well for the USD CAD as well. And that's all I got to say there. Let's take a look at the natural gas. Natural gas. This seems to be a pretty key level. This was one of our targets, going back, talking about, move into some of these higher levels, $4.24. And now you can see the 618 I use as a line in the sand, off of these. Let me just be clear here. Let me zoom out. And okay, if you look at going back in time, you had this high in place, you had this low in place, and it seems like my fibs have moved a little bit. Let me just reposition these fibs. Okay, I don't know why sometimes these things move, but if you look at, that was the high, that was the, essentially the low of this last move, and we came into the 618 around $4.24. I think these things move because when you get contract rollover, I don't know why, but the charts shift a little bit. So if you look at, there was overlap of this 618 into the 424 level, but if you look, you can see that this level or this zone here, going back from a support resistance perspective, was valid, and then it became another valid technical level based on this down move and a move back into a retracement back higher. We broke above it, and now we're coming back and testing it. So the question is 424 going to be the new support level major support level, and are we going to break to the high side? Do we have a lot more potential movement in the natural gas? And, to my thinking, I'm going to look at this from a decision point perspective. I think we need to hold $4.24. And you can see there's been a lot of activity around this level. You can see it's an important level. If we can break back up above this trend line, then I think we can come back up and test some of these higher levels. I'd be looking for a retest of the highs. So if we can hold 424 and break above this trend line, then I'd be looking for retest of some of these higher areas, 458 again, and then ultimately potentially $4.80. If we don't hold that, then I'd be looking for a pushback down into, let's say, $4.02. So these are really, here's our kind of our line in the sand, and here are our decision points, and the levels around that major level. So I hope that makes sense. Let's take a look at crude oil. So I thought crude oil was really going to push higher last week or the week before. The last time I was talking about crude oil, and I was just dead wrong on this. We did come up into $100 a barrel, which I thought we were going to test, and then I thought if we could get above $1.01, I thought we'd probably come in and test $1.01 and maybe push into $1.03. That we were getting into an area of resistance there, and then we just crapped out. We came right back down into $94 support. So $94 is a pretty key support level. At this point in time, we're holding around there. Momentum seems to be, I don't know if we're going to bottom out in momentum around 94 or retest $92. The question is, are we going to hold $94? Are we going to hold $92? And are we going to push back up? Like this, is this just, if you look at this on a shorter time frame chart, this kind of thing happens all the time where it will do this and then it'll keep moving. So these chart patterns just take a lot longer to play out on a daily chart. But because of the fractal nature of the market, you get a repetition in these patterns over many different time frames and many different instruments. And so I haven't given up on the long side of crude oil just yet. But if we break $92 a barrel, that would really put me more on the bearish side of crude oil. So I still, part of our analysis, I guess we were sort of a little bit right and a little bit wrong in our analysis. And I don't really care about being right or wrong. It's nice to be right, but you're not always going to be right in the market no matter what. And that's why when we actually trade these instruments, we use different risk, limiting factors, or we use different risk management rather. Whereas, first of all, we'll use stops, or we may use different instruments in order to be able to minimize our risk to, crazy moves like this in these instruments. So, for example, if you're, let's say, long this and it doesn't do what you expect it to do, well, you're going to stop out, when you get a push down and it does what you're not expecting it to do. So I hope that makes sense, and I hope for those who are trading these markets, obviously we don't trade every market we talk about, but for those that are trading these markets, you always have to use, in my opinion, you always have to use proper risk management and, position sizing. Don't go too heavy into a position. Don't be a plunger, that kind of thing. Those are things that you learn as you're in the markets for, long periods of time, and that, it's really about, people talk about number of occurrences, number of instances over the long term. Do you have an edge? Like a casino, they might only have a 4% edge. They're right 54% of the time, 56% of the time, but when they manage risk properly, they make a heck of a lot of money. I mean, if you look at casinos, they make an awful lot of money, and they only have to have, less than probably a 4 to 6% edge. And just, the discipline to stick to that in order to be, hugely, hugely successful. So keep that in mind going forward. You're not always going to be right in the market. It's impossible to always be right. So manage your risk. I hope that makes sense. But what I'm really looking at here is, we were partly right in the sense that we thought we'd come into $100 a barrel. We thought we might come into 101.55. There could be some resistance there. And then if we get above, 103, that's really, where things are going to get going. Well, that did not happen. We did get into these levels and then we puked. So the question now is going to be, are we going to reset momentum, hold some of these levels and then push back higher. That I'm going to be watching for. That's one scenario. The other scenario I'm looking for is that's the bullish case. So if we can hold these levels and then momentum can shift and we can push back higher, hold this zero line, that would put me back on the bullish side of crude oil. If we come back down and test, let's say $92 a barrel, I'm going to be looking to see if we're just going to probe through it and then hold, and have momentum shift off of that level. So $94 and then $92. If that does not happen and we break this level decisively, 92, then that's going to put me on the bearish side of crude oil. So we're in a really important zone here, and it'll be important to watch what happens to the market going forward. There's really the decision points and the decision analysis going forward. I hope that makes sense. Let's move on to, let me just take a quick drink here. I think I'm talking a little bit too much today and it's drying out my throat. Let's jump over to, I think these are some important drivers going forward. We talked about in last week some of the important drivers we felt were going to move the markets or things that we should look for. And one of those things was potentially higher stock prices going forward. But one of them was also in potentially commodities catching a bid. But one of them was also really, interest rates and the bonds. So if you look at the bonds, this is the 30-year, and the 30-year is at some pretty critical support. And then you've got support on this double bottom around, let's see, in the 30-year, that's around 127 and 132nd, 127, let's call it 127 even. 127 even. That's, I'm just going to change this here so that my data says 127 even. There's no point in splitting hairs there. It's a nice round number. And that's going to be the major support, I believe, in the 30-year. And let's make it a little bit more weighty so that it's a little bit more prominent. So we've got 127 as pretty key support. We're at intermediate support here. So the question is really, is momentum going to shift back to the high side? And are we going to hold these levels? And if we look at the 10-year, I'm going to be driving into the actual interest rate. So the 10-year is still net bearish, but we've had this up move and now we're into support. And the question is, are we going to hold some of these support levels and push higher? But really what I'm really looking at is, let's look at the 10-year yield. And if you look at the 10-year yield, the 10-year yield is right at a key inflection point. And what I really like, if you look at the 30-year and the 10-year bonds, they're at pretty important intermediate support. But the 10-year yield, the inverse, the yield curve is at, the 10-year interest rate rather is at, right testing this 3% level. And the question is, are we going to break above here and look at, I think this is the inflection point between, significantly, at least significant relative to where we are, significantly higher interest rates going forward in the shorter term rate. So the question is, are we going to break 3%, which we haven't seen for quite a while, or is this going to be a ceiling and this scenario be defended and we're going to roll back over in the 10-year interest rate? So this is, really important to watch going forward. This is going to influence a lot of markets. If you believe in correlated markets, which I believe a lot of markets are correlated today, this is going to be a key driver going forward and all of the things that it entails. You need to see how the market is going to react if we have higher interest rates. The Fed has already signaled that they're going to begin tapering, slowing down bond purchases. So if they start slowing down bond purchases and they actually follow through with what they say, then you would expect higher interest rates naturally, because there's going to be less demand for bonds. Less demand for bonds equates to lower bonds and to higher interest rates. So I hope that makes sense. And keep an eye on this. This is the in TradeStation, it's TNX.X, but it's essentially the 10-year. It's the 10-year interest rate. Okay, the 10-year interest rate, or the yield curve. The 10-year interest rate is it's pretty important. So let's this is going to be a key driver as we discussed. Let's move on to we haven't covered the metals. Let's see here. Let's look at the gold. So I wanted to get on the long side of gold. I actually missed this move, but you know, one of the things we were talking about over the past couple of weeks was, you know, are we going to hold this major support zone? If we break this zone, this is a key inflection point. If we break this zone, we're looking at around 1050, you know, 1,000 to 1,050 an ounce. Excuse me, if we break this major support zone. But if we hold this support zone, we may be looking at, you know, a potential bounce with a decent bounce higher. And if you look at where we could bounce into, you know, we've got levels, this 50% retracement of this high, you know, to this low could take us into 1272 to 1294 in the short term. And then if we get above that, somewhere around 1300 to 1324. So what I was interested in here was the fact that we had actually held this support zone quite nicely. And in fact, if you actually zoom into this and, you know, you analyze this, what the things that I really liked about this was, if you look at momentum was going higher here while the price went lower. You can see we spiked through this low. This is a technical divergence, and if you look at, I don't take trades based on technical divergences themselves, but I like to use technical divergences with signals. So if you look at the fact that, for example, we've got this technical divergence here, and then we broke above, you know, we put in this sort of pattern here where we broke above this, that's a heads up. But ultimately what happened was we broke this down channel. So this down channel for me in itself would be a signal right here. Now let me just zoom in here because I know it's a little bit hard to see. But if you look at this down channel here, the break of this down channel here off of this momentum shift and off of this technical divergence here, that is enough for me to get interested in a market and to want to trade a market. So I did actually miss this. I wasn't watching it closely enough. You know, over the holidays, I'm just sort of getting back into things. But I missed this. I would have liked to get in long somewhere around this level here. Let's see, this level here around 12, let's call it 1220, because you're not going to catch the absolute, you know, best level. But let's say around, I like this level around 1220 for a move into 1272. That's 50 points higher, you know, with a stop at these lows here around, well, I mean, you could look at a stop of these lows for just a better than 1-to-1 risk to reward ratio by the looks of it, you know, just better than 1-to-1. But I'd really like to get, you know, maybe a stop below this bar here, and a move into this 618, which would give you a higher risk reward percentage, higher risk reward trade. So I like this. You know, you want to see where momentum might top out into some of these resistance levels, and if it doesn't, and we can get something moving maybe into 1324. So it may not be too late to get into this trade, but I really like to get in early, you know, right around here, because now we're already trading, you know, 18 or 20 points higher than the get in here. So if we could get a bit of a pullback, I would like to see if that's going to hold, and then ultimately look for some moves into these levels and just sort of manage that from a trade perspective. I think we put in a short-term bottom. Now, that being said, if we actually crash and fail and we come back down through this level, then I think we need to look at that as a potential, you know, flip the script and go look at the short side of this market. But I really like this channel breakout trade, and maybe looking to initiate something there if we can get a bit of a pullback here, go down to a 60-minute chart and see if we can get some sort of an entry. But that being said, we may have already missed this trade. I don't like to pay up. And but I don't know, you know, have we already missed this trade? I haven't really figured that out yet. I'd like to see, you know, what happens going forward over, you know, Monday, Tuesday, Wednesday. We've already had, you know, we had the Fed announcement last week with Bernanke speaking, and the fact that this has moved higher after that announcement really gives me the confidence to, you know, to actually be more interested in that trade. I think whatever the Fed has said or done is not, that won't have a factor on this. They can really, really kill metals trades, with all their, for lack of a better word, currency manipulation. And I think now that we've had, this technical divergence, we've had the holding of this major support level, the break of this channel, the break of this swing high, really bodes well for, at least a little bit higher prices in the gold. So I hope that makes sense. Whether or not I'll get into this trade next week, if we can get a pushback down into maybe 1220, we can hold that level and push off. I'll be looking at some lower time frame charts, or if we've missed this trade, I don't know at this point in time. So we'll just have to assess that going into the early part of next week. Let's look at silver. So silver, silver has a bit of a different pattern here. Although we did, sort of had a channel here, but silver, I think the more relevant pattern is this triangle breakout, where we had a breakdown that we failed. This is a busted pattern, and then we broken up to the high side, from a Bukowski, from a Thomas Bukowski methodology kind of standpoint. These busted patterns are just, you go with them. And if we look at where silver might go, we have momentum higher in silver. This is a really early stage, and if we look at, here was, let's say, the high, the low, we could go into, $20.90 to $21.40. So I like silver a little bit higher. If we close below, let's say, $18.90, then I think, you would have to reassess that. But I like silver higher into, $20, let's say $21 to $21.50, maybe as high as $21.15. I don't like it if it breaks down below $18.90. So let's take a look at copper. Let me go back and clarify what I just said there. I don't like silver on the long side if it breaks below $18.90. So let me jump over to copper. Copper's finding some resistance around $3.41. And I mean, if we look at this, if we get a pull into, let's say, $3.32 is 21 exponential moving average, and we hold, let's say, this intermediate trend line here, I think that trend line is more significant, and this is more of an intermediate trend line, somewhere around there. We hold this, we hold a 21 exponential moving average, and we can get above $3.41. You've got a major resistance zone in here, and I'm actually just going to make this a little bit heavier. If we can get above this major resistance, I think we can really get something going in copper. The question is, are we set to move through there? Or are we, just going to start going sideways and maybe come back into some of these lower levels? I like how my trending indicator, if you look, the trending indicator has been negative since February, I guess the middle of February 2013. So that's, 11 months ago or so. And now we've just rolled back up to the high side, going back, 5 or 6 days ago. So the question to me really is, are we really ready to get something going in copper here and break out of this consolidation, get above $3.41 and move higher? I think this is really the key inflection point here to see if we can really get something moving to the high side. So until and if we get above $3.41, I think that's really going to put us on the bullish side of copper. So I hope that makes sense. I've gone on a little bit longer than I wanted to here. There are some important developments here, and I'm really taking a deeper, I'm trying to take a deeper look at the market going into the beginning of 2014 and start to get things going again. One of the things I've been focusing on is trying to learn a lot more about options, defined risk strategies, and I'll be talking more about them as I learn more about, how to really utilize options properly, and look at more than just purely directional trades, because one of the things that I'm finding, or that I'm learning, is that, through a lot of experience, a little bit of pain and anguish as well, is that directional trades are, if you just look at a directional trade, on the surface, you've got a flip of a coin. You've got a 50-50 chance of going higher or lower from any point in given time. Now, with technical analysis, obviously, the modus operandi is to improve those odds and to try to find high probability directional entries into markets where you can put those probabilities 55 to 75% or 80% if you're really really good. But some of the best stock pickers and portfolio managers in the world are right 60, maybe 70% of the time. So when you look at the probabilities of a directional trader, it really takes a lot of years to get good at picking direction and finding high probability entries into the market. But if you look at options with certain strategies and you look at probability studies and things of that nature, it's a lot. The probabilities are a lot, I don't want to say easier, but it becomes obvious that for those that have a hard time picking direction, with options looking at probabilities, there are strategies that you can use to take advantage of the fact that the probabilities are going to be lower from that perspective. I don't know if I'm explaining this well, but are going to be higher from picking certain option strategies. So it seems to me that certain option strategies or certain options methodologies are by nature higher probability than just trying to pick directions. So I hope that makes sense. I'm going to be able to put that more into perspective as I go deeper into this study of options. I have been I have traded options going back over the years here and there. I've traded options before even several years ago up until now, not consistently, but they've all been directional options trades. So I'm still dealing with the underlying directional trading the market from the challenges of being a directional trader. And I mean, having said that, you can do very well as a directional trader in the market. It's a skill set that's developed over time, in my opinion, and you get better as time goes on. You're never always going to be right. But what really it comes down to is making more money than you lose when you're right, losing less when you're wrong, making more when you're right, and putting that statistical probability or the edge in your favor over the long term, being right more than 50% of the time, and then hoping that with commissions and everything else, you're going to be more right than wrong, and you're going to make more money than you lose over a longer period of time. So I mean, as a directional trader, I think that's really the trading plan or the business plan. But I think in today's day and age, you really have to look at different possibilities and different ways of looking at financial instruments and different ways of trading markets going forward. So you always have to sort of expand your horizons, learn and see if you can incorporate new things into your tool set. That being said, there are certain things that work over the long term, and you really need to focus on just trying to be a little bit, trying to be consistent in the market. So I hope that makes sense. I guess this is something that's on my mind as we wrap up our the CSTA Oakville chapters trading and investing plan development series. We have our last guest speaker coming in, not ever, but for this specific series. He's our 5th speaker in the series. Jeff Perrant will be with us. He was with us last season as well. Fantastic presentation. So Jeff will be in to our meeting on January the 8th at 7 o'clock in Oakville. I hope you can make it if you've stayed with me long enough for this video. I'll also be posting it out in the text of that this video goes out with, to let people know that this is going to be the sort of the big bang explosion of our last guest speaker of this really important series. So next month we'll probably do we'll cover a recap. We probably won't have a guest speaker, but we'll recap the themes of the season, try to solidify these things, and then try to put things down on paper and say, okay, well, here's an outline or a structure of a plan. But until next month, until that happens, we're going to sort of wrap things up with Jeff. And Jeff is really, from what I understand, Jeff is really strong on trading, on risk management, on system strategy development, and money management. So I've asked Jeff to come in and share some of his thoughts on and his experiences on trading and investing plan development. It's going to be, I'm telling you, it's going to be a fantastic meeting, and I know it already, and I hope to see you all there. So Happy New Year, good trading, investing going into 2014, and hope to see you out next Wednesday at the closing of this season's trading and investing plan development series. So a little longer than I wanted today, so I'll wrap this up and hope to see you next Wednesday or at a next video update. All the best and good trading.